Hi, everybody. My name is Roseanne Bonavito. I'm the moderator for the webinar today. Today, we're going to talk about how companies go about overcoming the challenges of the new revenue recognition standards. I'd like to start by introducing our speakers. Our first speaker from Aria Systems is David DiPiano. He is the Senior Solutions Architect at Aria. David is a graduate magna cum laude from the University of Vermont with a bachelor's in business administration. David, his career has spanned several years in the field. He was an auditor with Ernst & Young. David was also a controller and had responsibility for evaluation and implementation of business systems, including ERP, SaaS billing solutions, T&E, stock-based compensation, and document management systems. Our second speaker is Tom Zali. He's the Vice President of Sales and Marketing with SOFTRAX. Tom has over 17 years of experience in sales and sales leadership with startup software companies, including SES, Hyperperformix, Parasoft, RPath, and ITKO. Prior to Tom's career in software sales, Tom worked as an electrical engineer for several global companies. Tom obtained a Master's of Engineering in Bachelor's of Science in Electrical Engineering. Tom is also named on 2 patents, and he's a graduate of the General Electric's Advanced Courses in Engineering and Business Management Training Program. So the agenda today includes the following areas. We're going to address increasing complexity for the back office. Within that section, we'll address market adoption of recurring revenue models. We'll also talk about and review the regulatory landscape. And then we'll also talk about important transition points. And within that, we'll also talk about why it's important to take action now. Then finally, we'll talk about the limitations of ERP platforms to manage the new rules. And then at the end, we'll take your Q&A. So let's get started. David, I'll turn it over to you.
Well, thank you, everybody, for joining us. We know you're taking time out of your busy days, and we really appreciate the ability to talk to you today. So the first thing we're going to talk about is what we're seeing from a market adoption of recurring revenue models. We're really finding that customers and prospects are really coming to us from a wide variety of industries and business verticals. Everything that these companies that you wouldn't previously think about, from automotive to healthcare to hardware manufacturers, and obviously the technology companies that have been selling things in a recurring model all along. These companies are looking for ways to transform their businesses and look for more creative and innovative ways to manage their new products and services. And we're finding that a lot of finance teams are actually liking the concept of recurring revenue because it becomes a little bit more predictable to manage and forecast their revenue than your more traditional one and done or ship a good out and you may not ever hear or see from that customer again. And sort of related to this, we're finding our customers are retaining their customers a little bit longer, and they're having a higher customer satisfaction resulting from these types of models that they're adopting. We also see Wall Street is rewarding these companies who have recurring revenue models with higher valuations, higher stock prices, and it's something that we're really looking forward to seeing how that continues to grow. The companies that are moving to these recurring revenue solutions and models for the first time, they're finding that they're really able to sell their goods and services in new ways, and we'll talk a little bit about how quick example of how that's happening. But we also wanted to mention really quickly that when we talk about recurring revenue, we're really not just talking about sending a bill every month or once a year, and it's kicking over a bill on a periodic basis. So when we think about recurring revenue, a lot of people have this thought that, it's a customer's coming to a website or they're calling you up and you're invoicing them, you generate a payment, and you're just repeating that process over and over again. But what we're really finding is there's a whole lot more steps along the process for ways where you can touch customers You can interact with them, and along the way, you can have different monetization steps. And this is really important because we're really not talking about a simple, monthly subscription and that you're just going to recognize revenue over time. What you'll hear a little bit about on the webinar today is all these different things and performance obligations are really, there's steps here that can have very real and profound impact on the way that you're going to recognize revenue. And you really are going to want or need the ability to be able to not only track these distinct and unique events along the way, but be able to track them and recognize revenue on them separately. So that's a really, really quick example here is you might have a customer who's on say a cell phone plan, and they have text messages of say 1,000 texts a month. And in terms of managing and the usage of when this customer is going to hit or exceed their usage threshold, from a customer satisfaction standpoint, it's very nice and beneficial to be able to not only load the usage data into a billing platform to bill them for the usage that they use, but also to be able to proactively reach out and say, hey, Mr. Customer, you're going to exceed your threshold. Let me tell you about that so they're not expecting any surprises in the next bill. But it also offers you the ability to upsell them into the future. So you may be able to increase your monthly recurring revenue and a whole bunch of other SaaS type of metrics along the way. So we talked a little bit about how customers are modeling their products into new ways to sell. So what we see here on the left side is your traditional software sales license model, where a lot of customers or companies that are coming from this background used to sell perpetual license software. So a customer would say, I want 10 licenses. It may cost $100,000 for the life of the contract, and maybe there's an annual PCS or maintenance and support fee along the way. Maybe that customer could purchase add-on training, and there wasn't a lot of ways that you could iterate on this particular model other than adding more seats or maybe attempting to negotiate additional training or something like that. But when we're finding some of the customers in this space have come and adopting the recurring revenue model, we really are seeing a series of options that these customers are taking of how they sell, model, price, and bundle their services. So here's a couple little options just, as we see. So first example might be the customer selling those same seats of software. They're going to bill the customers monthly. They may bundle that software in with some hardware. There's going to be an annual maintenance fee billed once a year, and they can add on services for training as needed, maybe through a customer portal. There may be another set of customers, they're buying the same software, but they're going to actually build in licenses as they use them. So in this particular model, maybe there's an online portal. A customer can go in, add additional seats for new employees as they start, and they're going to get a bill every month for the actual licenses that are used. So maybe your contract with them says you're going to always have a minimum charge of 5 licenses. If they use 3, they'll get billed for 5. If they use 7, they get billed for 7. And maybe under this model, the customer is going to get a monthly maintenance fee and also have the ability to add on and purchase some training modules that you may offer. And then there may be a third option that you build through a reseller channel. It's the same software. You're billing it. You're selling it through a reseller. The reseller is marking it up and selling it to their end user. But you may need the ability or want the ability to track that end user to be able to offer other services. Again, maybe like the maintenance and support or the add-on training. So all of these options can and will have very real revenue recognition challenges and differences, and we'll talk a little bit about the types of things that we're going to need to talk about and think about from a revenue recognition standpoint throughout this webinar. So we're going to hand this over to Tom, and Tom is going to start talking about the technology implications of the new standard.
Okay, thank you, David, and thank you, everybody, for dialing in today. I wanted to cover a few things on the call today. First, briefly, I wanted to review the basic tenets of the new standard, so ASC 606 here in the United States and IFRS 15 abroad. Talk a little bit about the timing for and methods of adoption, and then I wanted to kind of take a step back and really talk about 2 things. One is the just generally the delay factors that we encounter as we go through as a technology vendor, all of the implementations that we've done in the past, and what some of the key delay factors are, key drivers for delay in those implementations. the next thing I want to do is get a little bit more tactical and talk about some of the specific areas within 606 and where we see that there could be complexity for certain companies based on, the specific parameters of your company. At the end of the day, I'm hoping to leave you in a position where you can self-assess, is this transition to 606 from a technology and implementation perspective, is it going to be a very complicated thing for me, a very lengthy thing for me, or is it something that I can get through fairly quickly? And then I will hand it back to David, who can discuss some of the options that you have for getting to support for 606, and I would say for the types of new recurring models that David's describing as well. So ASC 606, it's very widely talked about these days, so hopefully this is review for most of the people on the line. The basic tenet is just to recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. So, in that statement, there is a lot. There's, and it's broken into 5, core tenets. The first is identify the contract with the customer, verbal or written. The second is identify the performance obligations, and this will be the first area that we'll talk about in terms of complexities. So effectively what it's saying is that, things that were formerly sold as a single entity, if you will, could actually have different rates of transfer in terms of the value of the goods or services to the client and should therefore be considered separate performance obligations. Determine the transaction price, for the arrangement, but then, the ability to allocate the transaction price to the different performance obligations that exist within the arrangement. And for some companies, this is shown to be a net new process for them. Others, some did not have to allocate under 605, may and under 606. And then the fifth, recognize the revenue as the performance obligation is satisfied. So what does it represent? And, clearly there's a little bit of hyperbole in this slide. The intent of 606 and IFRS 15 is really to try to bring the world together, I think, in terms of accounting. It is not the world of accounting in the sense of all of accounting, but it takes one slice of accounting, specifically revenue recognition, and not even 100% of it at that, and tries to bring, the United States and the rest of the world together. For a lot of companies, I think it represents a very big, compelling event. So we still see, in the United States and abroad, a very heavy percentage of companies that have complex revenue requirements resorting to either spreadsheets or maybe, the typical monolithic ERP with heavy customizations that, have problems in terms of vendor version lock-in. I think between the complexities in the new recurring revenue models that David described and the new regulatory framework between ASC 606, a lot of companies are really, it's an opportunity to assess, what do I have, how am I doing this, and maybe take that step into a cloud-based solution. And I do think definitely we're in an era now where you can do very complex billing and very complex revenue recognition with out-of-the-box products. I think it's very difficult for a single vendor from an ERP perspective to keep up with the complexity, but I think by deploying best-of-breed modules, you definitely can get there. And David will talk about that toward the end. So as far as the timeline goes, obviously different for public and private, and also 2 methods of deploy. So, public companies will have to start taking action with periods and, starting after December 2017, so think Q1 2018. For private companies, it's a year later. There's a couple of different methods for deployment. I won't go into too much detail. It's basically full retrospective or modified retrospective. In full retrospective, there's I'd almost call it more of a formal look back in the sense that you have to state revenue under the new guidance for some number of past periods. In modified retrospective, you don't necessarily have to state the revenue, but you do have to disclose how that revenue is different from how it was processed under 605. And, as we dig in here a little bit, we'll get into some of the detail and why that's important. Before we do that, let's just talk about, delay factors for implementations in general. And this would include implementations, of revenue recognition even under 605. And some of this might be a little bit surprising, but, At SOFTRAX, we have literally, hundreds of implementations under our belt. We have resources that have individually been on hundreds of implementations, been here for a while. And, interestingly enough, one of the most important things for you to assess is the availability of your own resources. So I would say that if you're looking at calendar time to get an implementation done, far and away, the number one factor to consider is how much time your people have to assist in the implementation. Not that, the vendors themselves or the integration partners that you can bring in can do much, but not all of the work, and they will rely on your people for knowledge of use cases, questions on data, et cetera, et cetera. Our rule of thumb is that if we can get 10 days a month, so half time from those resources, it's a tremendous amount. Usually it's far, far less. Again, on the topic of resource limitations, I think one thing to be aware of is that the trickle of companies deploying these things for 606 in the past few quarters is turned into a steady stream and is about to turn into a big rush. And I think it's going to stress the resources of the technology providers in terms of getting these implementations done. So I would not wait too long from that perspective either. The second thing I would bring out in terms of implementations really sits around data migration. And here you have to assess how much historical data you want to bring into the new system if you transition over. And I would say, if you're a company that's grown through acquisition, if you're either running multiple financial systems currently or you have data in multiple places, possibly data in multiple formats, those are things to assess because it's going to make the implementation, the first stages of the implementation, much more complicated in time, more work to be done. So that's something to think about there. The third thing that usually drives the length of these implementations is business complexity. Oddly, people think volume of transactions, but it comes down to really how many use cases do you have and how complex are those use cases. For some companies, it's recognition in total or ratable recognition and not much else. The far side of that equation is, you're doing complex allocations, perhaps multi-step allocations. You have multiple forms of the recognition of the revenue itself, percent of completion, milestone, ratable, in total, et cetera. So that will be a factor, and it will drive the amount of effort, and your people will be involved in this in terms of how they articulate what those use cases are, construct the tests that will be necessary to test for those use cases through the transition, et cetera. And that is a segue into the final point, which is testing issues. So, somewhat related, but driven by the number of different types of recognition and the amount of complexity you have. And then I skipped over integration issues, but the integration for a revenue recognition system is not necessarily that complex. It consists of usually 2 or more feeds of data. I would say that if you are in a situation where you have multiple upstream or downstream systems, if you have lots of situations where you have to put revenue on hold, so you have sort of, think of it almost like an asynchronous behavior where revenue is taken off hold based on signals from third-party systems, and there's a number of those third-party systems, those will represent integration layers. So I sell hardware, let's say, I can't recognize revenue until the hardware is confirmed to be shipped, and that's a signal coming from another system that tells me I can recognize the revenue. So those are some of the general factors that drive the delay. Let's move down now and talk specifically to ASC 606. So in the coming slides, we're going to talk about some of the things that we're seeing in the implementations that we're doing now that drive complexity. So, we'll talk about separation of performance obligations, variable consideration, standalone selling price, the time value of money, dual reporting disclosures, and importantly, the final one, managing changes and adjustments. So we'll take these, one at a time in turn. So we talk about separation of performance obligations and variable consideration together. We do that not because they're similar from an accounting perspective, but because there are similarities in terms of how the underlying technology has to automate these things. So, for those that are not aware, separation of performance obligations, it's a situation from a technology perspective in 605, you have the same task to perform when you sell something as a bundle. So you sell something as a bundle, it really needs to be represented by, let's say, three actual entities. The the automation technology's task is to take in the bundle SKU, if you will, and automatically, we use the word carve, but automatically carve it into three separate items that potentially could subsequently participate in an allocation of revenue. In the case of separation of performance obligations, you have an entity come in. It's not getting separated into different SKUs necessarily like a bundle, but there are distinct performance obligations associated with that entity, and they need to be treated independently. And so the technology itself has to do that same kind of a split. When you're thinking about these, and through the remainder of this deck, I refer to standard and non-standard scenarios. So I think both from a data migration and from an automation of processing perspective, the one thing I'll say is that automated solutions are very good at repeating standard things. So if you have a performance obligation or an entity that has really three underlying performance obligations and it's the same split every time, then from a technology perspective, you can set that up and you can get that accomplished in a very automated way. If you have anything that's non-standard that has to be dealt with on an exception basis, it's important to understand, the volume of that, because you will have to apply potentially human intelligence to it, and it becomes very hard to automate. Further, if you have a large number of performance obligations or instances where you have to separate an entity in multiple performance obligations, it too could affect implementation times because each of those has to be set up as a separate configuration within the system to automatically handle the split into the various performance obligations. Variable consideration is similar again in the sense that similar but more complex. And what's happening with variable consideration is you have an entity come into the system, the revenue needs to get recognized, but because of some future event, some of the revenue has to be held back effectively, placed on hold, if you will. So, for example, perhaps it's a certain amount, but if a timing event is not met, it actually represents a discount or something like that. That discount amount would have to be held back. And so, again, from a technology perspective, the ability to carve out the piece that has to be held back, if it's a standard percentage or a standard amount or a particular fixed value that has to be held back, it's not a problem. The additional complexity is that it has to be placed on hold. But again, the automation should handle putting it on hold as long as it's a standard type of condition. And again, where you probably will run into trouble is if you have many of these that have to be set up, and or you have a lot of exceptions that you have to deal with on a case-by-case basis. It shouldn't necessarily really exist, but if it does, it's something to watch out for. The next one we wanted to talk about is standalone selling price. And so on surface, standalone selling price, from a technology vendor perspective, it does not look very different from the existing calculations of fair value, and I would say, primarily proportional allocations or relative allocations. So, the task here for those that might not have to do allocations currently, you have to declare and prove a standalone selling price for each of the entities you sell. And when the overall transaction amount comes in, you have to effectively allocate that revenue proportionally to the various elements within, including anything that results from the separation of performance obligations, and you have to do it proportional to the standalone selling prices that have been established for each of those elements. Now, one area to think about is, A, do I have this? Is it very complex? How many different SKUs do I have to manage? How many do I have to calculate the standalone selling price for? But also in a look back, so anybody that's doing like a full retrospective adoption, keep in mind there's a synchronization and time issue here. So you're processing transactions from, some number of periods back. You need to in order to correctly perform the allocations in 606, you need to know what the correct standalone selling price would be for each of the entities within that multi-element arrangement, within that allocation, at that particular time when the allocation is occurring. So there's probably calculation that needs to occur, possibly multiple calculations that need to occur based on historical data to establish what the standalone selling prices should be for each of the periods. And I mean, these things typically change on an annual basis. They're updated on an annual basis, so it shouldn't be overly burdensome, but it is something you may have to do more than once. And you have to ensure that the correct values are used in the allocations for the appropriate times that those allocations occurred in the past. So there's a bit of a synchronization there. The final thing I'll say on this is if you have a very simple price book, you're selling very few things, and it's sort of one-dimensional, then probably not a terribly large effort for you. But if you're a company that sells many, many different things, you're going to have to determine these fair values. And where we see even greater complexity is if you sell, many things and there's another dimension. So, for example, I sell widget X, but I actually can declare a different fair value depending on whether I sell it in quantity of 100 or less, 500 or less, 1,000 or less. Then you could potentially end up with 2 or more dimensions to your price book and potentially a large number of standalone selling prices that you have to determine and maintain and apply in subsequent allocations. So, again, a good, modern revenue recognition subledger will automate all of this, but it doesn't mean the work goes to zero. So something to think about. We brought the time value of money into the deck. This is an interesting one. Given where interest rates are today, most of the companies we're talking to are finding that the time value of money is immaterial. However, interestingly, in the past weeks and past couple of months, maybe we've run into a few companies that do need to consider it. I think it probably is more important if you're a company that has very long contracts, 3, 5, 10 years, or very large contracts. I think it'll get more important as the interest rates change. But again, this is an activity that involves some sequencing as well, because, and again, thinking about the look-back period in full retrospective, if you're trying to account for time value of money, you need to synchronize with the interest rates that were existing for those past periods, coincident with the recognition events. And again, so companies with long-running contracts, companies with very large contracts, probably something to consider. The next one is dual reporting and disclosures, and these are I think, some of the most often talked about elements of ASC 606. Companies want to make sure that they can report according to both standards. The reality is, I would say, from a vendor perspective, it could be some of the easiest things in the standards to implement. You're talking about data stored in a structured database, so the task here is to be able to store effectively at least 2 revenue policies and potentially more, but at least 2 revenue policies, let's say in the US 605 and 606. And you have to be able to configure your automation to automatically run, one set of transactions through the system twice, coming up with probably different recognition rates depending on whether it's in the 605 or the 606 book. But no major gotchas here. I mean, it should be very doable. The other thing is you have to be able to report on that revenue, but again, because you're in a structured database and, with a modern business intelligence tool, which most of the subledgers come bundled in with, the reporting should be fine. So, on the disclosure side, I mean, these disclosures still have to be written. The only thing that the technology vendors are doing, here at SOFTRAX, and to my knowledge anywhere, is basically allowing for an automated mapping of disclosures. So what will happen in this situation is you're effectively writing a disclosure regarding why the revenue recognition is the way it is. The technology kicks in by automatically tying that disclosure based on a mapping mechanism to the appropriate revenue items as they come into the system, and effectively doing the bookkeeping on that mapping for you. And again, I don't see a major issue here as you go through your sort of self-assessment. The last one is probably one of the most important ones, and this is important for 2 reasons. One, it's often overlooked. So in a lot of the evaluations that we see as companies are thinking about, how am I going to adopt 606, they're thinking about, can whatever solution I'm looking at handle the setup of the revenue, the schedules? Can it handle the task of allocation, separation of the various performance obligations, and handling of variable consideration? Excuse me. However, an important question to ask is that revenue ever touched once it's set up initially? Meaning, do you do any kind of post-processing where you either change schedules, maybe you have linkage where you have to reperform allocation? If you have that, then when you do your assessment and thinking about how long it's going to take to adopt, and really also the work involved in a go-forward basis, I think it's very important to understand what kind of changes and adjustments do I have, how frequent are they, and can the technology automate it? And keep in mind, if you're in a look-back situation, you're going to have to perform any changes that occurred to the revenue through the prior periods when you do a report, as they were done at the time they were done, and it's not something to consider. This is probably the most often missed activity that we see in the planning phase and causes these things to drag out. So to sum up, in terms of your timing for ASC 606 adoption, if you're looking at full retrospective, and depending on how far back you have to look, I would say if your revenue recognition policy is very simple and you don't have any of the, you're not hearing any alarm bells on any things we've talked about so far, simple data migration, relatively simple complexity in terms of the recognition itself, then you're possibly safe to wait a little bit before you start to implement. So the extreme, at the extreme, one would wait till calendar Q4 of 2017, and you're probably starting to approach risk no matter what your complexity is. If you're full retrospective adoption, you're going to have to do much more of a look back if you take that approach. The other extreme is almost like a full proactive adoption, where even though you don't have to report until Q1 2018, you're basically processing revenue according to both sets of books. And we do have a number of clients that are taking this approach, so they're being very proactive about it. They've already implemented. They're moving forward and processing revenue according to both sets of books. If you have any of the complexity I talked about today, I would encourage you to not wait too long on that look back. I mean, the lower the amount of time you have to look back, the more time you have to get things done, I think the safer you will be. With that, I will turn it back to David to talk about options for implementation.
All right, thanks, Tom. So we're going to talk a little bit about a couple of the options that you have to implement some of these procedures or the technology to comply with these new rules. And, some of these are pretty obvious, but, we should talk a little bit about them in a little bit more detail. So the first is really just totally replacing your ERP system. We often come across a lot of customers and prospects that they're thinking about the new revenue rules, they're thinking about recurring billing, and one of the options on the table is to totally replace their ERP system. We know it's something brand new. Other options that are on the table is they've got a team of developers, or they're going to hire a team of developers and write their own solution. So they're going to take the standards embodied in ASC 606 and basically write their own data warehouse or their own custom application to start tracking these things themselves. Other options are the trusty finance person's spreadsheets. There's a lot of power in spreadsheets and Excel, but there's obviously some risks, which we'll talk a little bit more about. Some of our customers, they have very powerful ERP systems, but they may not have the modules necessary to use for revenue recognition, especially under these new standards and as it relates to recurring billing. So some of the options on the table are, to go to their major ERP and purchase and implement additional modules or add-ons, or maybe even some third-party solutions that are partners of those ERPs to get them what they need. And then obviously, the last option is what we're talking about, Aria and SOFTRAX, which are purpose-built revenue and billing solutions. There's a lot of benefit, in our opinion, of what you get out of those types of solutions. So when we talk about whole ERP system replacements, there's a couple of risks that we believe you should know about. First is, anecdotally, there's their ERP systems often have very long implementation life cycles. Most of them are all over a year, with the average being almost 18 months. So if you back up and you think about when is ASC 606 going to be applicable, and you really add up the timeline to implement, it really doesn't leave you a lot of time to, even if everything goes perfectly smooth and successful, to test the system, make sure you can retroactively apply it, the new standards to your business. You know, and in fact, some of these implementations, over half of them go over schedule, both in time, in terms of time and money. And the worst thing that can happen is you get a new system in place, it goes over budget and time and money, and then you wind up finding out that it's not going to work for you. It doesn't fully support the new standards. That could be very devastating to your business, you know, both public and private companies alike. So when we talk about spreadsheets and custom code and custom applications, these are often data-driven solutions. So they're really designed, and you're thinking about what they do is they're taking a massive amount of data and allowing you to manipulate them to produce the information that you need. But you know, when you start thinking about what Tom is talking about and digesting the new standards, these new standards really have a lot of process elements to it. So you know, you need to think about, you know, what are your performance obligations? When do these obligations happen, and when are they satisfied? How are we going to carve out the value of your sales amongst the component pieces? And as it relates to these solutions, really version control and security and application and program change controls become really important. You know, companies like Aria and SOFTRAX, you know, this is what we do. Our businesses are built around the complexities and logistics of recurring billing and complex revenue recognition. So if you're going to be building these things internally, you want to make sure that, you know, if you're going to do it, your developers fully understand, or are working with your internal finance teams, your audit teams, make sure they really understand these rules, especially if they're making changes to applications internally. Specifically related to spreadsheets, there's always the risk of human error and version controls. I mean, I know in my previous life, I've always had situations where you spend hours working on something and find out that you started with an old version, you've got to redo everything. So these manual solutions really amplify the risk of error when you're using spreadsheets, and you know, it's really detrimental to mess up revenue in more ways than one. You heard Tom talk a little bit about needing, or the necessity to manage two or more sets of books. You know, basically termed the old set of GAAP and the new set of GAAP. These become pretty difficult or time-consuming when we're talking about these manual tools. And it will work. I mean, you can make these things work, and we have customers that are thinking about or doing these. But in our opinion, these are likely going to fail in the long run. So what do we suggest? You know, when we think about a system architecture and a best practice standpoint, this is really a really high level of what a system architecture might look like. So, you know, your customers are coming to you, whether it be through a direct sales force, working with your sales teams, whether it be a customer portal. So if you have existing customers and they're logging in and making changes to their accounts, you know, they're adding services, removing services, modifying services. And of course, you might be an e-commerce type of business where customers are adding items to their shopping carts and checking out. So these systems will integrate with your billing and collection systems, in this case, something like Aria. You know, and Aria is going to be managing the bills, the collection attempts, and we're going to be integrating all of these things that your customers purchase with the revenue system like SOFTRAX. And what SOFTRAX is going to do under these is they're going to take all these bundles, they're going to take the plans and the services and the goods and the kits that your customers are buying, and they're going to start unwinding them and figuring out what are all the component pieces, especially related to the performance obligations. They're going to try and allocate revenue amongst all those pieces. And as we're billing them, you're going to be, in some cases, switching flags from unbilled revenue to billed revenue. And these things don't happen in a vacuum, right? I mean, you're selling hardware or you're fulfilling tangible goods. We, of course, need to integrate with provisioning systems and fulfillment systems, but these also need to talk to the revenue systems to tell it services have been turned on. We can start the clock on recognizing revenue if that's what your model and rule is. We need to tell the revenue system that goods have been shipped or that obligation has been satisfied. So these integrations become important, and you heard Tom talk a little bit about these integration points. They really are more important than ever as related to these new rules. And then, of course, these systems are going to produce a series of journal entries for you to recognize revenue and all the other financial transactions. So this is really an overview of the recurring revenue, the new revenue standard, and what a best practice architecture might look like. So for that, we'd like to turn it over to our Q&A.
Great. Thanks, David and Tom. I thought that was really interesting. We have quite a few questions. I think I'll just start with this first one. And it looks like, David, this one is for you. The question is, with the CRM, billing, ERP, provisioning, and revenue management systems all working together, how does reconciliation fit in? It seems like there's a lot to sync. So, David, it sounds like a good question.
That's a great question. So when we're talking to our customers, this question comes up quite a bit. You're right. I mean, when you're talking about keeping any systems that are separate, integrated, you're right. Reconciliation is a pretty important piece. So some of the things that our customers are doing, there's sort of a couple different tiers. The first is, the very standard tried and true model where reports are being spit out of both systems. You dump them into Excel or some other spreadsheet, and you manually match them up to look for things that are different or they don't match, or if one system is not complete, it has information that the other doesn't. But we have some tools actually built into Aria that our customers are using. It's a workflow engine that's built around the platform. It does a lot of other things to allow you to modify your business practices and your automation, your solutions of things that Aria may not do out of box, but it's custom and unique to your business. And so some of those things are reconciliation procedures. So what this workflow system can do is ingest files and calls from other systems and try and automatically attempt to reconcile accounts or transactions and either provide a notification or a report of things that are different or unreconciled, or taking it all the way one step further to say, something is missing in this system, let me try and resync it. So yes, reconciliation is a really important piece of keeping systems in sync. Okay,
great. So the next question is, if I'm looking at both a recurring billing platform and a revenue management system, which should I select and implement first? David, sounds like that might be you.
Sure. Yeah, so I guess I'll add my thoughts and maybe have Tom add his after me. So when you think about revenue systems and billing systems, especially an Aria and a SOFTRAX, they're two different systems, but they really share a common set of data. We can't bill what isn't coming from order entry systems, and revenue systems are vitally dependent on those order systems and the billing platforms. So my suggestion is when you're talking about, two things as important as revenue and billing and monetization, you really assess those two together. And the reason I say that is, my experience tells me that when you're trying to implement two systems that are that important, you really only want to integrate them once, right? You want to identify the integration points. You want to set your internal controls and your reconciliation points only once, and really put them all in together. My experience has said that that's probably the best solution. But maybe Tom, you could add your thoughts too.
I definitely agree with that. I think that just historically speaking, the most successful implementations we've seen have been when actually members of the billing team and the RevRec team are in the same room together, and that would include both internal resources as well as vendor or system integrator resources. I think it gives you a very good, clean initial deploy and probably a more flexible deploy over time as well. So I would follow that recommendation.
Okay, great, thanks. Looks like there's another question that just came in. I thought this would be good. Does Aria come with an integration to SOFTRAX out of the box, or will there be a custom implementation? This attendee wants to gauge how long it will take to get both up and running.
Let me take that, Dave?
Yeah, sure.
So there isn't a productized integration available out of the box as of today. There's a prototype integration that we use, the professional service organizations use, that currently gets, I'll call it, semi-customized for deployments, but the companies are moving toward a more productized integration over time. In regards to the amount of time to deploy the two solutions, it's very tough to say because it depends on a number of factors, some of which I alluded to. So, some of these deploys in a very simple case can get done very, very quickly. Others, if you're a multi-billion-dollar company, many divisions, multi-currency, multi-company, many different use cases can take on the order of 6, 9, even 12 months. So probably the best bet is to reach out to one or both companies, and with a little bit of discovery, we could probably get a much better estimate to you.
Okay. Next question. My ERP can handle reoccurring revenue. Why shouldn't I use that? I've already invested a fortune in it. David, do you want to take a stab at that?
Sure. Yeah, it's funny. We actually hear this quite a bit on our, when we're talking to prospects and existing customers. Really, when we start talking about ERPs, we're not suggesting that ERPs can't handle recurring revenue or even some of the new RevRec standards. Really, what we're trying to talk about is agility. We find a lot of our customers are coming to us and saying, we know our ERPs can do this. We know we have to implement, or add additional time to customize our ERPs. And so some of the concerns are really vendor lock-in and whether that's going to reduce their flexibility for how they want to run their business in the future. So if your ERP can do what you need it to do, by all means, look at it and see if it can do what you need. But, anecdotally, we're finding that a lot of our customers are coming to us because they don't want to use their ERPs.
Okay. Here's another question. How does the architecture that you just showed sync with competing products like SAP RAR, and what are pros and cons of your approach?
Go ahead, Tom. You can take that, and I'll add my thoughts.
Sure. I mean, I think one important concept to convey is that ERP is not necessarily going away in this paradigm. I mean, I think the most successful deploys that we see keep the ERP. People use the term ERP backbone, so they keep the structure of it. They definitely keep the general ledger. The intention should be to look at the areas where your business is either complex now or where you think it's going to be complex, and augment with best-of-breed modules. Some people use the word hybrid cloud strategy, what have you, but if there are areas in your existing ERP where you're feeling pain, and by pain I mean, you've had to migrate work to spreadsheets, or you're supporting an expensive customization that prevents you from upgrading, the net of it is there are a lot of function-specific modules on the market that are very deep in functionality that allow you to remain in the box, reduce your costs. You'll probably see tremendous improvement in the reporting, support for audit. The reality, in my opinion, is that no single ERP vendor can keep up with the multidimensional change that's going on right now. They just can't do it. And I think, the answer here is to look at these, best-of-breed modules and augment where it makes sense.
Yeah, if I could just add to that, I mean, some of Aria's most successful implementations are with customers using these legacy ERPs, including SAP. This kind of gets back to one of my earlier slides where, we have a customer who was using SAP and still is using SAP, and to add a single product, SAP, told them it was going to take them 18 months to go live. So what they decided to do is implement Aria to get them to market quicker. But, on a lot of our SAP implementations, what we're finding is a lot of that core infrastructure is really remaining, and Aria remains a piece off to the side where it's handling the recurring revenue and integrating both with order intake, fulfillment within SAP, and then pushing the transactions back into SAP, for final mile, recognition, maybe in revenue or, fulfillment, like I mentioned, and obviously all the financial transactions. In some cases, SAP is integrated with their payment processors or their provisioning system. So, it is very much possible, and we do it all the time, to integrate with SAP.
Okay. Tom, this question is for you. What if I'm already running part of my business under IFRS and another part under US GAAP? Is it possible to track both of these and ASC 606/IFRS 15 within the revenue subledger?
Yeah, so that's a great question. So when vendors are supporting the new guidance, what they're effectively doing is creating, or should be doing, is creating an ability to support effectively multiple books of accounting. So you're enforcing, at least 2 revenue policies in the subledger and running them in parallel, different configurations for each. What this question pertains to is the limitation at 2, or can there be more? And I can't speak to the space in general. I know for SOFTRAX, we call this piece of functionality N books, and so we have clients either deployed or deploying right now that indeed have this issue where they're running IFRS and GAAP already, and they need to run the new standard. I would say that additionally they might run other books for some type of non-GAAP accounting, whether they're doing what ifs or what have you. So it's a good question. I think if you're evaluating solutions, definitely check to make sure that more than 2 books can be supported.
Okay. Tom, there's another subledger question. Let me read this to you. What is the impact to audit in leveraging a revenue subledger?
So, I think, related to spreadsheets or custom solutions for sure, and probably even related to some of the ERP solutions that are out there, you should see a very dramatic improvement in certain aspects of audit. So just to give 2 examples, and this is from the SOFTRAX perspective, and again, I don't know the rest of the market as well, but from a SOFTRAX perspective, there's a couple of elements of this. First of all, the revenue policy itself is enforced in the application. So when you're dealing with your auditors, you can present to them that, look, here is our policy, and here's how it is applied consistently, with security and controls to every transaction that comes in. Now, when that policy changes, so somebody changes, maybe configuration parameters such that, this revenue was recognized ratably on this SKU, and now I want it to go in total, something like that. We track, every change, both, what the change was, what the before and after picture was, who made the change, when they made the change, and then we expose that in a set of audit reports. So, for example, I want to see all changes that were made to my 606 policy between these months, that kind of a thing. The other thing is from a transactional perspective, anytime, once the revenue, an individual revenue element, a chunk of cash, if you will, enters into the system, any event that occurs to that element, whether it's an allocation, whether it's a scheduling, whether it's some kind of, post-processing like a recalc in line or a true-up, again, it's all tracked at a very granular level, who made the change, which, ideally hits the system most, if not all of the time. When was the change made, and what was the before and after picture to that revenue item? So, they're both in reporting and support for audit. There should be a very dramatic improvement in reporting and audit, which will have downstream effects in terms of your ability to automatically reconcile and in other areas as well.
Thank you. This question is actually for both of you, so here it goes. Are these deployments done out of the box, or is customization required? Tom, do you want to go first?
Yeah, I'm sorry, Roseanne. Can you repeat the question for me?
Sure.
You broke up on the first part.
Are these deployments, for either product, are these deployments done out of the box, or is customization required?
Also a good question, and I think that this speaks to what David was discussing about the pros and cons of deploying a module such as this. So, at least on the SOFTRAX side, everything that we do is out of the box. If a client has a requirement, we have a policy regarding requirements. If a client comes to us and there's something that they wish the solution to do that it can't do today, we will assess it. If it's something we don't currently support, and it's a pretty rare event at this point, but if it's something that we don't currently support and it's standard GAAP or standard ASC 606 or IFRS, then we will modify the product and support it as supported product going forward. And we effectively, it's a multi-tenant SaaS environment unless you deploy on-prem, and so it would be done that way anyway. So the idea here is to preserve a zero customization environment.
Yeah, and I'll add to what Tom had said. I mean, Aria is also a multi-tenant SaaS provider, so essentially all of our customers are running off the same code base. So like most SaaS systems, there's configuration. So system flags and switches that say I want to be able to do this or that or do it a slightly different way. It's built in and baked into the product. But you heard me talk a little bit about our workflow environment. And this was really something that Aria had added to allow our customers to take the core of Aria one step further and say, we can allow you to integrate Aria with other systems. We allow you to call Aria from other systems and then introduce your proprietary business logic within this workflow environment that's wrapped around the entire core of the platform. So, we like to think that is our magic sauce that takes the platform one step further and allows you to customize and configure it to your business, not the way that we tell you need to do it. And of course, Aria, like SOFTRAX, we have our data models can be expanded and added fields, and if you need to track additional information inside the data model, we allow that, and we expose the platform through APIs. So there's a lot of out-of-box functionality you can get, but we have a lot of customers taking it a whole lot further than that.
Great. All right, well, we are at the top of the hour, just a little bit after, so I want to wrap up. I want to let everyone know that you've got some information on the screen right now if you want to reach out to Tom or to David. You will all receive a follow-up email, and in that email we'll give you a link to the replay of the webinar as well as a PDF of both presentations. Thank you all so much for joining today, and I want to thank our speakers. It was a great webinar. Thanks.
Okay, thank you.